Thank you, everybody, and thanks for the opportunity to be here with all of you and for this really esteemed panel. I think Mark set the tone for us really nicely for this conversation, so I hope you have a lot of love, sweet love in this discussion. So as she said, I'm Kahir Dhanani. I'm a managing director and partner at BCG, and I'm really honored and privileged to be moderating this panel with our colleagues here. So I think everyone's names have been said, so I won't go through it again. But I will say that this panel and this group of individuals is very uniquely pulled together to represent a number of different perspectives. Susan represents the perspective of the DFI community through the IFC. Ahmed represents the perspective of private investors through Allied Climate Partners. Dylan represents the perspective from the Sovereign Wealth Fund and the asset managers. Madame Odile represents the perspective of the multilateral development banks, and Andrew represents the perspective of philanthropy. So we have, across this discussion, a number of perspectives that we're bringing to the table, and hopefully that gives us a really nice opportunity to have a good conversation around the topic of blended finance. And of course, blended finance is a major theme of this COP. In fact, climate finance, you heard the announcements last night, a number of these announcements really talking to the need to expand the amount and the efficiency, I would say, of finance for climate and, in fact, for development. We've done some analysis at BCG together with the Rockefeller Foundation on the need, and what we found is that the need for climate finance is in the range of about 3.8 trillion a year. But really, when you look at all the sources of capital going towards this, whether it's MDBs or ODA or DFIs or private investors, companies themselves, other investors, we're only at about 16% of the way there. So that means that the capital that we need for this agenda has to come from somewhere else. We know that the DFIs and the MDBs have a certain amount of finite capital. The question is, how do we get it to go even further? And so blended finance is potentially the key to that. So that's the intention of our conversation here, to sort of get a little bit of thinking around this topic. So to start off with, I'm going to start our conversation through discussion of one question around generally what are the solutions and what are the challenges to solutions across your perspectives. And then we'll go into specific country or individual by individual, perspective by perspective views on the blended finance topic. So let's start with one question to everybody, which is, from your vantage point and the seat that you are, what are the challenges to scaling up climate solutions? So we'll start with you, Susan.
Great, thank you. I would say, look, the biggest challenge we're facing today is time. We have an incredible urgency. Time is running out. Right now we have developing countries that are moving behind on meeting their development goals. We have 700 million more people in poverty and in extreme poverty. We have floods, hurricanes, droughts, climate shocks that are putting people further and further behind. So we need to act very quickly. As I look back over the last 10 years since the Paris Agreement, I think that we can all be very amazed at what technology has delivered. When you look at the cost of commercial scale solar or wind, or even progress on technologies like carbon capture and storage, it's been tremendous. So the world has done what we do best, which is technological advances. But now comes the really hard part. It's adoption by local communities, and it's the political and policy environment that's going to enable adoption of these technologies. And this is where the rubber hits the road, and that's what this COP is about. It's really accelerating momentum. So we'll talk more, I think, later in this discussion about the local community adoption angle. But let's talk about the policies. This is where blended finance comes in and where organizations like development finance institutions come in. We can work with governments and help create that pipeline of bankable projects. And so that's what's lacking. The world has trillions, hundreds of trillions of dollars of capital, but how do we make it flow faster? And part of the answer will be what Mark called sweet equity, what I'll call blended finance, but we all mean the same things. How do we de-risk to get that private sector capital flowing? And I think that's what this next conversation will be about.
Great. Thank you, Susan. Let's go to the perspective of philanthropy, over to Andrew over there.
So the question is, how do we do it at scale?
Yeah.
And the answer is, we're not thinking big enough. We don't have a sort of investment banking mindset at the scale that is large enough. So, for example, if you look at large initiatives recently, for example, the so-called JETPs, the Just Energy Transition Partnerships, brilliant diplomacy by the G7, doing deals, you know, Vietnam, $17 billion, then stop building coal-powered plants, great. But what was lacking was getting senior enough people from all of the different players that Mark was talking about to the table at the same time. So we had a bunch of governments that were very well-meaning. We had private sector sitting on the sideline. Philanthropy was sort of waiting in the wings. Bilateral donors, you know, need to play a role. DFIs and the multilateral development banks partly involved, but not adequately. So what we really need is a deal team for the planet.
I love that concept of a deal team for the planet. Madame Odile, from the perspective of the EBRD.
I would say from my perspective, 3 key challenges. The first one is to get sufficient bankable project, to get a pipeline, and it's not, you know, to create a pipeline of project in which you can invest, you need to have political commitment, administrative capacity, in a country, all the players, you know, the energy suppliers, the distribution company, and so forth, needs to be aligned on an objective and getting the trajectory right. And issues like lack of carbon price, fossil fuel subsidies are key component if you want to drive investment in the right direction. So what we need to work on is policy packages, and then with the financing component, of course. But in order to really get, the capacity to invest, because what we see in a number of countries is we are willing to invest, but we don't have project, and we need to build this pipeline of project, and this needs times, and it's a lot of political economy. The second challenge is a number of projects need really soft money. They need subsidies to be, public financing up front. Some countries do not have the capacity to do that, and that's where you need blended finance, grant financing, and so forth. And the last point is the capacity, the appetite for investing in this geography on this kind of project. When you have bankable project, you still miss, in a number of cases, the private sector appetite to come in, because it may be because of regulation. International banks would say, well, we have Basel and it's much more costly for us, and the return on capital and so forth. The macroeconomic may be not right enough, strong enough. We've been working a lot, for example, in Egypt with a big so-called JETP program. Macroeconomic doesn't help to bring investors, and nobody can guarantee the macroeconomic risk at scale, I think. So all these components are absolutely needed, and these are, I think, in my view, the key challenges.
Thanks, Odile. Dylan, from your perspective from Temasek.
So let me start by saying that the problem is a very big one, made more difficult by what we've seen in the last few years with, first of all, COVID-19 and the stresses that have been put onto countries, communities, and even the world as a whole. And secondly, now by the issue of persistent inflation and rising interest rates. And that's a big issue, because if I think about the last two, it does mean that capital is flowing more back towards the developed markets, and therefore less available for the emerging markets and developing economies. And that's a big issue, right? Because then we can have solutions which can meet the requirements in developed markets, but we have a big problem in dealing with the needs of the emerging markets and developing economies. So maybe I'll come back by saying that there are two pools, I could call it two pools of capital, for want of a better word, available. On the one hand is governments, which should be responsible for setting up frameworks which are there for for other players to come in and work under so that there's predictability. Very important. If you want to attract capital, you have to have predictability. Nobody can guarantee the outcome, but there must be some predictability in enticing capital to come in. The second, of course, is MDBs and DFIs, because they have a critical role to play and have historically played a very big role in EMDEs. And there is an element of trust sometimes there that they can leverage on. But also because they have a multitude of different instruments that they can bring to bear. And the question then is, how do you unlock them for broader application? Okay, and we can talk about that as well, because the World Bank is moving in that direction. It'll take some time, but hopefully we'll get there. The third, of course, is society itself on the public side, because it has to accept that there's certain trade-offs in having to move to a better world for themselves and future generations. And the question is, what are those trade-offs which are affordable for societies, and what are those which are not? And then those which are not, you have to figure out how to plug the gap. Then on the other side of the equation, like a balance sheet, sorry, I'm an investor, so I think like with a balance sheet in mind. On the other side, you have the private sector. And I would say there are 5 players in the private sector. The first would be established companies, because they're the ones who are in industries, they're the ones who need to make the transition as well, they're the ones who can contribute towards a lot of the tech-based solutions becoming mainstream, because they have existing positions to deal with that in the long run may become negative for them. And with them, secondly, is the innovative companies. So they tend to be tech-based solutions in particular, but even companies who provide services which are critical, because as you think about what we need to do to get to just transition, the most important thing is to make sure that you have data and accurate data. So measurement, verification, certification becomes important, because it also goes to the issue of predictability and attraction of capital. Mm-hmm. The third is people like us, investors and financiers, who have a role to play. And for us, it's a question of risk and reward. And so your risk-based capital is dependent upon what reward you want to get. Okay, so sometimes a financial reward, and sometimes it's a non-financial reward, and that's where we have to think about where concessionary capital fits between philanthropies and even investors. And the fourth category will be philanthropic organizations like the Bezos Fund. We have Temasek Trust, so a big chunk of money from us have gone to there. And so because they have very clear KPIs as to what they're supposed to do in terms of the capital that's put to them. They're not supposed to get a return like we're supposed to get a return. So they have a double or triple bottom line. And the final part is intermediaries, people like BCG, folks like marketplaces, whether it's a carbon marketplace or otherwise, because they become an enabler for some of the financial models which are necessary there for the risk and reward equation. So I would say that you have to ultimately bring together a coalition of the willing to address the bigger problems out there. And these are, from my simplistic perspective, are the 8 players who all have a role to play in the outcomes that we want. And as an investor, we're just one of the 8. But to be honest, GFANZ has $140 trillion of AUM committed to doing something for net zero, right? The question is, how do they want to allocate capital for the right outcomes? And the right outcomes are financial, but also non-financial. Because at Temasek, we believe that quite apart from doing well, we have to do right, because we only have one planet to deal with, and we all are citizens of that planet, and humanity has to prevail, and we have to do good. And remember that as much as we look for impact for climate, there's also the issue of impact for communities, and for them to have access to what we enjoy in developed markets is a big critical issue in energy transition as a whole. Thank you.
Thanks, Dylan. Ahmed, your take.
Yeah, so you had asked the question, what are the biggest challenges? And I think, let me address the biggest opportunities, which I think also represent the biggest challenges. And the first thing I'd say before offering my own perspectives is that this is such a complex problem. It's a bit of a kaleidoscope. I mean, everybody on the panel, while we're expressing our views in different language and from a different vantage point, actually there's a lot of commonality in what we're saying. And perhaps that'll be true of what I say as well. I think there are 3 really important areas where there is potential for disruptive change in light of significant changes in the broader ecosystem in the last several decades. And I think they're all very, very relevant for catalyzing step change function in climate action. The first is the power and potential embedded within new and more catalytic kinds of partnership. If I think about the work of development, which I was involved with in my prior role and this one, the single biggest change in the development ecosystem in the last 30 years is that 3 decades ago it was very lonely work. People from Odile and Susan's institutions would visit a country and meet a Ministry of Finance or a central planning unit, and that was it. Today, everyone in this room thinks of them as an ESG actor, as an SDG actor, as a development actor. And while there has been an enormous resurgence of new interest, we haven't turned it into new forms of partnership that are highest common denominator in impact as opposed to something other than that. And so I think we need to keep investing in these partnerships. The second challenge, and this is something that Mark was talking about, is really the need for disruption around the problem of capital formation. And I think one of the consequences of a relatively long and static era in financial markets is a focus on cost of capital as the driver of marginal change. It's actually the absence of risk capital that is the binding constraint on a number of the problems. And by the way, these three things are all interrelated. How do you catalyze incremental risk capital? In part, it comes from an institutional investor defining itself as a steward and recognizing that certain problems were out of scope are now in scope. In part, it comes from a philanthropy, which says, oh, I don't just need to be a donor, I need to be a catalyzer of private sector action. And in the same way, it requires MDBs to also pivot in terms of what they're doing. And the last thing I'd say where I think that disruptive change is necessary, and this is sort of the foundation of the other two, is the intellectual toolkit with which we approach our work. So much of the modeling, so much of the thinking that we have done for a very long period is really based on sort of static equilibrium models that assume you know nothing about the future, that assume there are no feedback loops, we have no idea what a technology is going to cost in 5 years. That static solutions like carbon tax, which is a good idea, but those alone are sufficient. And so I think we have to recognize that we are in an era of very broad tectonic shifts, not just because of climate, but because of many, many other things that are happening. Those demand revisiting issues from first principles, building new kinds of partnerships, introducing new interventions that allow capital to form in new ways. Always doing that with a very fundamental sense of ownership of outcome, right? So many of our institutions are focused on intermediary variables because that was how we measured outcomes in the past. It no longer works. An MDB can't look at lending volumes into climate. A philanthropy can't look at disbursement numbers. An institutional investor cannot only look at this year's financial returns. So always owning the outcome and keeping this broader mindset in perspective. And then the last thing I'd say is, and all of that has to boil down to hyper-specific interventions against really, really specific things. Mm-hmm. I think what we're trying to do at Allied Climate Partners is one little example of trying to create a new kind of partnership, trying to take a new approach to capital formation, being open-minded with respect to the intellectual ideas undergirding, but then being hyper-focused on a specific problem.
Thanks. I was going to summarize, but I think, Ahmed, you summarized for me through that. So let's move then to the next set of questions specific to the institutions. So, Susan, I'll start with you. So from the IFC's perspective, what do you see as the role of blended finance in terms of these new partnerships that are required? What are some of the activities that the IFC has taken on this issue of private capital mobilization? What have been some of the successes you've seen, the instruments that you've used?
So blended finance, I think, is critical to unlocking the trillions of dollars of private capital to flow into emerging markets, which has been noted isn't happening. And indeed, in an era of higher interest rates in developed countries, we've seen a reversal of capital flows. So blended finance, quite simply, is the de-risking element that allows private capital to go to emerging markets. And this can take many forms. It can be a first loss guarantee. It can be a junior equity position. It could be a subordinated loan. It could cover the cost of a foreign currency swap. All these instruments are the same, though. Let me, first of all, emphasize, it's not a grant. This isn't corporate welfare. This is returnable capital. This is an investment, but it's taking the riskiest piece. And by taking some of the risk off a project, we enable it to go forward. So the projects that we use blended finance for would not happen without that de-risking element. And so this is expanding the pipeline of investable projects. Now, there's a lot more work that needs to be done, and I'll get to that, on how do we create a much, much larger universe of potential investments for private investors. But blended finance is really critical. It also has a big leverage component. So this donor capital, every dollar that IFC uses for climate, we get roughly $10 of commercial investment out of it. Allied Climate Partners in their new fund is looking for a 47x leverage ratio. The point is that by taking the edge of the risk off, you can then enable layers and layers of leverage on top of that. And so this is critical for going, as we say, from billions to trillions. This is the key missing piece. Now, where does blended finance, where does a donor capital come from? Well, it can come from anywhere, but it comes from sovereign governments and increasingly philanthropies. So I think most philanthropic organizations, foundations, are used to giving out grants. Blended finance is a new concept, but it's something that we're seeing more and more happening, and it's a great way to get much larger impact out of very scarce catalytic donor capital. Now, MDBs, DFIs, whatever, development institutions have an important role to play here because to create this pipeline of investable projects, it's tough. And you need people on the ground. It's very hard to do a deal in Nigeria or DRC unless you have local staff on the ground that can work with the local companies, work with the governments, work, as we say, upstream with governments, first to get the regulatory and legal conditions in place to enable the private sector to operate in a country. And our colleagues at the World Bank, of course, do a lot of policy work with governments as well to create the conditions, first of all, for the private sector to come in, but then even to execute the deal and to work with the client. It's incredibly challenging. So as has been noted, everyone in this room probably considers themselves an ESG investor. So we have very high performance standards for the companies that we invest in for meeting labor conditions, climate conditions, treatment of indigenous peoples, preserving biodiversity, having transparent corporate governance of the company. These things are hard to come by. It takes a lot of advisory work and capacity building with the clients that we invest in to meet these international standards before we or other private investors can come in. So DFI, so the development community has a really important role to play in originating those projects, creating a larger pipeline, and then working with the companies to ensure that these commitments are met. So overall, I think it is an exciting time. I think that this conversation, the fact that we're having a whole panel on blended finance and the role of philanthropic capital to catalyze investment is a good first start. And I hope in the years to come, we're going to see this really take off and expand.
Great. Thanks. You closed on this point of philanthropic capital, and you said that a bit earlier, and the new models and new ways of thinking around what a foundation can do and should do in terms of deploying their capital. So Andrew, coming to you, you lead a formidable philanthropic institution at the Bezos Earth Fund. From your perspective, what makes philanthropic capital different, and how have you used it in recent examples to advance this agenda?
Well, I hope nothing formidable about us, but we are privileged to be entrusted with $10 billion that Jeff Bezos set aside to provide as grants for nature and climate this decade, up until 2030, when the Sustainable Development Goals are supposed to have been achieved. And I know there are many philanthropists in the room, and we're very keen to work together. We have a role to play that I think is helpful. Obviously, philanthropy can move much more quickly in some instances. It can take a different kind of risk, much more of a kind of venture capital approach, invest quickly, learn quickly, and then, as my boss likes to say, 10x it if it works well. The important thing is, whilst overall philanthropy for climate change now is probably well over $10 billion a year, sounds like a lot of money, it's obviously small compared to, it's 1% of $1 trillion, say. So what we look at in our philanthropy is every single grant we make needs to do two things. It needs to be successful at the project level, and within that project level, it needs to leverage additional resources. But then it also needs to be part of a creation of a movement. We no longer can just stick with projects, as Susan was saying. We need projects, but projects need to multiply themselves. Each project needs to lower the risk for others, and we need movements. The way we operate is we look at 50 transitions that are needed this decade and next. Some of them are obvious, like we've got to triple renewable energy capacity by 2030. If you start thinking about it, there are actually about 50 of them. And we run something called the System Change Lab together with the World Resources Institute. And we monitor all 50 of them. And we ask the question, how close are they to a tipping point? And how could we remove barriers? How could we play a catalytic role? So let me give you a couple of examples. One, together with the Rockefeller Foundation and the IKEA Foundation, we created something called the Global Energy Alliance for People and Planet. The idea there was there are lots of fantastic organizations working on energy, all doing a very good job, most of them doing a very good job. Plain fact of the matter is it's not adding up to the scale that is required. So they might be doing a good job within their own sort of project approach, but actually how do you then get that into the kind of scaling that we need? So we put about $1.5 billion of grants in a fund, and then we convened, if you like, an alliance of all of the serious players, including multilateral development banks, the IEA, a lot of countries, a lot of companies, DFCs, and so on. And the idea is, could we, for the first time, see if we could actually do things a little bit differently? Could we, if you like, lubricate with the resources that we have, the $1.5 billion, so we could put some money in the World Bank or the IFC? We have relationships with virtually everybody, I think, on this panel, so that we could, if you like, make the whole add up to more than the sum of the parts. Sometimes that involves the kind of direct junior equity that Mark was talking about. Sometimes it involves project preparation, sometimes political lobbying, sometimes accountability mechanisms, according to what is actually required. So that's going very well, and tomorrow we'll be having, today actually we'll be launching a battery storage initiative where we bring for low-income countries, how do we really accelerate battery storage? Another one, and then I know that Ahmed's going to talk about this in more detail. Mark hinted at it. Allied Climate Partners, to us, is a brilliant initiative. I commend it to you, essentially for the first time, trying to bring private money into serious project preparation in the developing world. Today, the Bezos Earth Fund is announcing $25 million of a grant that will then be invested as junior equity in a series of funds that will prepare projects. That in turn will bring in DFC and DFI money because they couldn't take the risk on their own for project preparation, but if we take the first loss, they're willing to do it. All kinds of MOUs are being signed today and tomorrow towards this end. And then the beautiful thing of this is that even although almost 40% of such project preparation, which takes 2 or 3 years, never reaches financial closure because it's quite risky, so we lose our money there. It turns out that the rate of return on the remaining 60% enables us to get it recycled and go around once again. So it's a very, very exciting initiative. I don't want to steal Ahmed's thunder because he's the CEO of this whole thing, but since we're announcing $25 million, I asked for permission if I could mention it before you do. So thank you very much.
I think, Andrew, you said you're not formidable, but in this case, you are the thunder. Let's be very clear.
Good. So why don't we actually then jump straight to Ahmed. Ahmed, can you share with us a little bit more about what Allied Climate Partnership is? A lot of the discussion we've had so far has been around this issue of risk and bankability and, different sources of capital absorbing different types of risk. So share with us your perspective on that topic and on what Allied Climate Partners aims to achieve.
So, I was saying earlier, you have to focus on really specific problems. And we need to pick the problems that represent really high leverage interventions with respect to climate action and climate finance in the developing world. And I think for a long time, there has been consensus that a dearth of equity flowing to early stage project development, i.e., if it's a $100 million wind farm in a developing country, ironically, the later 95 is easier to find than the first 5. Mm-hmm. And so there has been historically a well-recognized dearth of early-stage project development equity. And so ACP is an effort to focus on that problem. Now, how is it going to focus on that problem? By investing in local institutions who are already doing that work, by being very careful in selecting in 4 regions, Southeast Asia, Africa, India, and Latin America, Caribbean, at least one local firm that already has the capacity to do that work and that is doing it, then leveraging the risk appetite of philanthropy to provide that specific firm with first loss capital. That first loss capital then unlocks potentially capital from the DFIs as well as from the institutional investor community. All of that is intended to accelerate the flow of funds to a specific problem, but also to do so in a manner where that capital is directed to a very carefully selected platform that we expect, based on very careful work, to be able to successfully deploy that money successfully, return it to investors, and do it again. And in many ways, it is an effort to try to leverage the best of the various capabilities of the various institutions on this platform. The trust, the knowledge, the public purpose capital of DFIs and MDBs, the scalability of the institutional capital of sovereign investors, and the risk appetite of the philanthropic ecosystem. And what I would say ultimately, coming back to this point I was making about purpose, and Dylan gave a very good breakdown of what every actor in the system can do, right? Intermediaries, banks, companies. But some actors in the system have more leverage and impact than others. And I think it's no coincidence if you look around the world and you say to yourself, who are the world's universal owners? There's 3 kinds of universal owners in the world. Governments, institutional asset owners, and philanthropy. And so these 3 actors, the 3 we see here, both have more responsibility and more capability to be the instigators of the rest of the ecosystem. And what we're trying to do at ACP is to try to help catalyze these catalysts with respect to a very specific problem.
That's a very helpful explanation of ACP, and I'm very excited about what could happen and will happen with ACP. Odile, from the perspective of the EBRD, as you have heard this conversation around different ways of catalyzing, how would the EBRD engage in a process of partnering with philanthropic capital, with other forms of capital to increase the overall size of finance for climate?
So I think we are a bank which is focusing on the private sector, a bit like IFC, but still we can intervene on the public sector. So we have 70% of what we do in the private sector, but we can invest with sovereign and sub-sovereign still for a quarter of our investment. And I think we really see our role as helping, as I was saying, project preparation, but more broadly, a big part of our role and what we can bring to private sector players and so forth is the way we can accompany countries in transformation in order to put in place the policies, the strategies that will unlock and will increase the appetite for investing in these countries. And this is in particular true for climate change policies because these are policies that requires long-term planning. We talk about 2050, we talk about 2030 targets, so it's not, it's very important not to look only project by project, but to have an assessment at the overall approach of the country, the overall regulatory environment, what is the objective and what will be the means, so that to create this dynamics around investment. And this is what we call a sort of holistic approach, a transition approach, which is really had much more value, I think, than financing, one plant here and one power plant here. To do that, I really believe, and it's a bit like the banking team you were talking about, country platforms will be very important, and they are becoming a reality. I think that with MDBs, but with the country being at the core of the country platform, really defining its objective and so forth, and bringing the different partners, philanthropy, MDBs, DFI, and private sector around a common strategy. And with that, it's also a way to create incentives for countries to move on, because a number of countries, it's not easy to take a decision to shift. We work a lot with countries which are very dependent on coal. For example, I mean, we are in Central Asia, Central Europe, North Africa, Middle East. In Western Balkans, countries depend on coal on 70%. It represents a huge workforce. I mean, lot of labor, lot of social impact. It's secure. Coal is on your ground. You know what it is about. You're not willing to take the risk to shift, and you don't know, you are dependent. And what do you do about the people? So I think in order to move on and to really convince countries to move on, you need to have a global offer where you can provide support for the just transition aspect, the local dimension, how you reskill people, how you retrain them so that they can benefit, how are you going to transform your grid system and grid financing, the network, electricity network, for example, that requires soft money very often. It's public infrastructure, which requires some soft financing. And then you can develop huge amount of renewable, which is now very, very cheap, and you have a lot of private sector developers ready to finance renewable. You can bring private investors. So this global approach is absolutely fundamental so as to unlock the project, and MDBs can bring a lot into that discussion. So I think that's, and then working on the financing part, I fully agree with what has been said on the blended finance. So it needs to be, it's really case by case, because I think the risk is very different across countries, depending on the kind of project. But we need to be able to, we need to step up in that kind of financing. But when I was talking about this mobilization effect, our assessment is that with our financing, with $1 invested, we have $1.5 mobilized, directly and indirect. We can go beyond, and if we take into account the policy impact, I think this is much, much bigger. But this is something where we need to have everybody around the table in order to, put together, as the different initiative mentioned, the different set of instruments and the sort of financing in order to maximize the leverage.
Thanks, Odile. Dylan, your perspective on getting partnerships moving between institutional investors, new actors like Allied Capital Partners, MDBs, and DFIs. What will it take?
Yeah, so thanks for that question. It's actually a very complex question, right? Let me say first that we have to define what blended finance may mean, right? It's almost like trying to define the global south. You're never quite sure what the real definition is. Blended finance to me is the culmination of the availability of a pool of capital that will catalyze other pools of capital based on a risk and reward equation for those pools of capital. So the one that you look for is the one that can be most catalytic. That is the one which is the junior piece. You can call it first loss, you can call it the grant piece, because it's important. It goes towards, as was mentioned by Andrew, I think, about project development. It goes towards even capacity building and things like that, depending on what you're looking for. And then there is a broader definition of concessionary capital, which is not necessarily only first loss. That is a cheaper form of financing. Okay, that philanthropic capital can make work as well, because especially if they want recyclability, so that you have a better impact for the dollars that you have. It also includes the fact that some investors are prepared to get a lower return on a blended basis, for example. And then, of course, you've got to have the fact that with these cheaper costs of capital, you've done two things. One is that you've de-risked the opportunity that's coming to you, and that's the first loss piece in particular, but also part of the concession capital. But the second is enhancement of returns to get to the acceptable return framework for the other investors, whether they're financiers, whether they're providers of equity capital or mezzanine capital or whatever, and also at the end of the day, the people who are running the project as a whole, the sponsors. And ultimately, blended finance is about getting to a blended cost of capital that is low enough to have the other players get a blended return, which is high enough to justify the risk and reward. So it's a very complex thing, right? Because you need almost all of those people that I spoke about. The governments with the framework for predictability, and of course, when it comes to renewable energy, the PPAs and the like, you need the MDBs and the DFIs, not just because they can unlock instruments which are important, whether currency risk, political risk guarantees and the like, but also because they have capabilities which are needed for capacity building, which is very important, especially in emerging markets or developing economies, right? Because you want to make sure that the transition that you're playing towards is one which is able to see a multi-decade outcome. You got to have also, and then if you think about it, it is also about the companies and their willingness to actually take on projects which have a higher risk, but we can bring down the cost of capital, then that helps them do so. You have to think about the fact that different investors have different rates of return, right? And the question for investors is whether they are prepared to put some of the capital in concessionary capital and the other part into commercial capital for a blended outcome. Now, it's easier to do so because you want to be disciplined as an investor. If you have a pool of capital available for concessionary, whether it's through a foundation or trust or something, and you have a separate pool of capital which is looking for disciplined financial returns, because it's a disciplined financial return that's going to get you to do the project on time, with budget and so on, because at the end of the day, you want the return so that more capital is available to catalyze more action, right? So if you think about all that, it's about, having, like I said, a pool of capital that can catalyze other pools of capital. And who's the party in the middle? That's always the big question, Everyone's willing to participate, but who's the one who's going to bring it together is always the issue. Now, that's where you have to think about systems-based approach as against a project-based approach. When you look at it project by project, it takes a long time to get things going, to get things moving. If you have a systems-based approach, whether you come through an allied capital partners type structure, which is a fund, or whether you come through a platform that you create, or whether you go through a company that is actually willing to transition, you need a systems-based approach. I just want to mention one other thing, if I may. In all these things about blended finance and things like that, the most important thing that we should think about is not just the word transition. It's about a just transition, okay? We talk about energy transition, and by the way, unfortunately for us, the discussion is getting a little bit problematic because obviously in today's world, you look at energy transition and you look at energy security. And if you think about what's happened in Europe in the last 2 years and with reverberating consequences around the world, and if you look at what's happening in the Middle East, the focus on energy security as a form of national security is heightened. It's now a very significant issue for everybody. But if you look at emerging markets or EMDEs, you're looking at energy affordability. And as much as we focus on the green transition for the E part, we have to remember the S part. Okay, I know ESG is a much vilified term, and okay, we talk about sustainability as a whole. But if you think about sustainability for communities, impact for communities, the S is important. The S is very important. It's about uplifting communities, and you've got to think about the green transition working for them in a way which is affordable for them, and that requires a lot of these players to come in and plug the gap. Okay. And so if I think about that, the other part about it is, of course, the workforce. When you think about just transition, you think about a number of jobs which are out there in the coal sector, especially in Asia, because 60% of Asia's fuel source is actually coal. And you're talking about managed phase out of coal-fired power plants, about, I think, something like about 2,000 CFPPs in Asia, 5,000 units. And you have to phase out 2 a week to get to the 2040 target of all being phased out. Then you got to think about the jobs which are going to be displaced. And that's not just about coal, right? It's about every industry, the jobs being displaced. And then you have to think about workforce training, workforce transformation. And we think about that because everybody deserves dignity in life, and dignity of life first comes with dignity of work, right? When you think about that, then the problem is who's going to bring that in? Governments can do part of it, but the companies have a role to play there, and so do people who can help in capacity building. So as I said it's a very complex issue, and it depends on who's going to be in the middle making it all happen. I frankly don't, I think investors are not the best equipped to make it happen. They're the best equipped to make the capital available, but not to make it happen.
Yeah, that's a really clear. I want to pick up on this comment, this point about communities and just transition, and go actually down the line with everybody, sort of sharing your perspective on this topic of how this process of making investments, but ultimately thinking about the ultimate beneficiary, the communities and their inclusion, and what displacements or transitions need to happen there, and how we think about that. So Susan, why don't we start with you, and then we'll go straight down the line. And I think Dylan will skip you because you've given a really good articulation already.
So local communities are going to be essential. They are either going to be the biggest promoter of the climate transition or the biggest barrier. And so we've got to bring them into the tent. I think about this issue of energy access. So work that we did with the IEA came up with our own trillions of dollars figures on what's needed for the climate transition in emerging markets, and it's 2.8 trillion a year. That's triple what's being invested today. But we also measured how much would it take to give the 770 million people that don't have access to electricity access. It's only 45 billion a year. It's less than 2% of the overall need. If we devoted it to giving people access to electricity, we would transform lives and we would transform local communities. So as we think about a clean transition, and of course that's a misnomer in emerging markets, mostly they don't have power, so Asia being accepted, over many parts of Africa, you have countries where the access to electricity rate is less than 20%. Less than 1 in 5 people have access to electricity, let alone affordable, reliable power. So that needs to be part of what we do, is as we think about the climate goals, we've got to think about the goals of making communities participate in this success, because then they'll be part of the beneficiaries. I visited a solar farm in the Caribbean, where land is very scarce on a small island nation, as you can imagine. And so to build a commercial scale solar farm is actually taking up very valuable real estate. If they combined it with frankly, goats, with livestock, and so the goats graze under the solar panels, and you're able to that way free up the land, but a farmer who had the land to begin with could continue with his livelihood. So we've got to think about ways of bringing the local community in and being beneficiaries very directly and tangibly, whether it's through job creation, opportunity creation, getting access to the power or clean water, or better managing waste, to make them part of the solution. Because if we don't, they can be a major barrier to actually getting to where we want to go. And not to mention, it's the ethical thing to do as well.
Thanks, Susan. Ahmed.
Maybe just three quick comments on that. The first is that it was really interesting to me that we all obviously work for institutions that are deeply invested in the idea of a just transition. It is the daily work of everybody here and everybody in the audience. But the first person to mention the phrase was an investor. And that really reflects, I think, something important about Temasek, but also about how the world is changing and how various institutions are stepping up to our collective responsibility. So I wanted to just take special note of that, because 20 years ago, that is not the way the conversation would have proceeded. The second thing around just transition is it is a series of very, very specific problems and interventions, and those need to be planned for and addressed. Coal is one example, but as we have learned in the wake of the last 20 years of financial history and globalization is not always, certainly not in the near term, a win-win phenomenon. And when you do not account for the costs that are paid by people, not only do you cause suffering, but you will cause volatility and disruption in everything, including your political context. And so there are many reasons, from the basic value of human dignity all the way to self-interest, but it's a series of very specific problems where the public sector in many cases will lead because it's a public good, but others need to follow on. Coal is an example. And then the last thing I would say, and I think this is really important, there is a narrative in the world that decarbonization and development are competing objectives. And of course, it is always true that capital can go here or there, and those two don't always overlap. But I would say a couple of things on that subject. First, decarbonization is also an enormous development opportunity. I personally am convinced if you want to be remembered the way, for example, the leader of Singapore is remembered, as a transformational leader of a country, somebody who accelerates its path from underdeveloped to developed, the trillions of dollars of capital that will move, the technology that will shift, these represent enormous opportunities. Those are not opportunities for every country, but for some, this is an incredibly powerful train to ride. And even for those who do not necessarily see an industrialization path along this corridor, the level of institutional focus globally on this issue makes it an opportunity for every country. Development has always, to some extent, been an altruistic exercise, to some extent based on a paternalistic narrative of rich and poor. It is today a self-interested exercise in a way it has never before been in human history. The future of the grandchildren of a wealthy person on the Upper East Side of New York is entirely dependent on the actions of Indonesia. Mm-hmm. And so recognize as a pragmatic matter that this will be the greatest resource in accelerating focus on development issues and for driving just outcomes.
Yeah. Odile.
No, I just fully agree with what was being said. And we see, I mean, in my view, so in the just transition, there is this question of human capital is absolutely fundamental. And to get, I mean, to have this focus and to take care of how to deal with the impact on people is key, and that's where, for example, we are developing a partnership with Bloomberg to help with North Macedonia is a country in the Western Balkans. They are going to commit to close all coal power plants by 2030. It's a huge effort. They will develop massively renewable. They have a lot of people working in this sector. How do you accompany them in finding new job opportunities, reskilling, and so forth? One important dimension for us in this impact on people is also the woman dimension, because very often, in the new, more, renewable, new energy sector, new climate-friendly investment, women may be lost out because they are maybe less engineer, less in scientist training, and so forth. So this is an important dimension that we need to take into account. Another dimension from the local perspective is the fact that local players, local industry exporters need to be trained and accompanied in their own transformation, because they will export, they will work in a world where the standards, the requirements, the level of expectation on being able to show that your production is green, is up to the standards. We are in all the Western countries, all the large part of countries in the world are raising the level of requirements for imports to be in line with what is expected for the green transition, and so helping local companies, local financial system, and so forth to integrate that dimension and be ready, not to be taken by surprise, not to be too late, is very important. And that's why, for example, we work in a number of countries on sectoral, so sector by sector, industrial and with financial institutions, on what are the local carbon pathway, in order to what are the right strategies, how to take earlier enough the right technologies in order to be ready for, and on time for the transition. And I think that's a very important also dimension of the just transition.
Thanks, Odile. Andrew.
I'm very glad Dylan raised this the way he did, because you made the point it's difficult, and it is. And especially as we think about putting investments together, as you say, my goodness me, just getting all the players and all the financial pools together, that's difficult enough with the government, with the regulatory agencies. My goodness, we're exhausted. Oh, and by the way, there's a community And the environmental movement has done a weak job, quite frankly. The climate change movement has done a weak job thinking through the whole idea of social equity and the just transition. It is changing very rapidly, and that is very, very encouraging. And I think the very phrase "just transition" is extremely helpful done right. Mm-hmm. Now we, for example, are financing retraining of coal miners and those that work in coal generating stations in South Africa. But it's a pinprick, quite frankly. I mean, we're just beginning to think this through. And you think about the massive transition in moving from internal combustion engines to electric engines, huge impact for the workforce. And so we're trying to think this through, as many other institutions are. And it applies just sort of throughout almost everything. You know, you might think in the United States, where I currently live, everything is sorted. It really isn't. So even when the President of the United States comes out with a policy, which is a really, really good policy, President Biden, he said from now on, 40% of all the money we're going to put in to the transition, and there's a lot of money, obviously, in it, $1 trillion, as Mark said earlier, and 40% is going to go to disadvantaged areas. And you'd think, you know, a country as sophisticated as the United States, you'd have a little lever you could pull in Washington and the money would go down. Well, even figuring out where those disadvantaged areas are, and then the way that a federal system works is actually quite complicated. The money is like one of these pin, you know, you put the ball in and you're not really sure where it lands. If you want to get that federal money, you have to know how to apply for it. You need to have actually some pretty sophisticated skills. So we've put $300 million actually in the hands of environmental justice groups in the United States, absolutely on the front line. And part of that is to help them pull in federal money, so to speak. And the reason we need to give this attention is not only because it's morally obviously right, but it is, as Susan says, it actually helps get the job done. It is actually people on the front lines that are far more competent to know exactly how to spend certain kinds of money than those that sit in capital cities. So it's a very exciting time, I think. In this COP, for the first time, education is being taken seriously. There's an education day, and actually, starting at 12:30, in 15 minutes, at the other auditorium here, there's a program called Skills for the Green Transition, and it's incredibly important. I mean, it turns out that under current trends, half of all of the children that will leave school in 2030 will be ill-equipped even for today's economy, let alone for tomorrow's. If we want, you know, we tend to say, what's the problem in terms of the transition to a green economy? It's money. How do we find the money? Well, yeah, actually it's also people. It's people, and we need to give a lot more attention to that. And we need to pay attention especially to the disadvantaged. It turns out that whilst public and aid money for climate has been rising, aid money for education in real terms has been falling, and that's not good enough.
Thanks, Andrew. We have about 2.5 minutes left. Did you want to say jump? I'm gonna ask for a quick lightning round of, in one sentence or so, you know, what is the key message you want our audience here and others to take away from our discussion on blended finance? Susan, it starts with you.
I'll leave you with a proverb. If you want to go fast, go alone. If you want to go far, go together.
Ahmed.
I think we need to all ensure that we individually and collectively are focused on the singular outcome, which is parts per million.
So I'm an optimist, because to be an investor, you have to be an optimist, right? Can you imagine having an investor who's a pessimist? Look, I believe in human ingenuity will transcend all difficulties. And somehow, collectively, I can't believe that we can't find the solutions to unlocking the way to solving a problem. I really don't think that we can do it. And the reason why I believe in that, and it's difficult thinking this is coming from investors, I believe in humanity. I believe at the end of the day that when we do things which are human-centered, human-led, we will get to the right outcomes, because we'll just have, it's only one race, right, the human race. And so we all have a role to play. We just have to find out how best we can play those roles and get the outcomes we want. I actually believe that that everyone is interested in finding a solution to the problem. All of us have to come together and bring our collective wisdom to figure out how to bring that solution to bear. Because no one person in this entire mix of the coalition willing can do so. And I believe at the end of the day that will come about because there's momentum to do it, and we are all motivated to do it, not just for ourselves, but for future generations. And so that's my take.
Thanks. Odile.
My take is that we should always have in mind what will happen if we don't act, and the cost of non-action versus the cost of what we have to do. And I think that's something we very often focus. I mean, and we are right to look at what we need to invest, what the trillions are needed, and so forth. But what if we don't do it? I think the cost for all the players, the government, but also the private sector, investors, I mean, and of course for people, it would be much worse. So I think that's what should drive really our thinking and our action in that field.
Andrew.
Private investment in the green transition in emerging and developing countries, excluding China, needs to increase, sevenfold by 2030. We would love to work with you to create a deal team for the planet, so we think much, much bigger than we are right now.
Thank you very much, everyone. It's been a really great